It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
All right. Welcome to Macro Monday.
It's getting a little better. It's getting a little better. Hello, everybody. We're just messing around a little bit. Give some people some time to get on. It's cold out there, Johnny. We got to get warmed up a little bit.
It's been cold. It is cold, and it will be cold. It's just if you're in this streak, you might as well go for the record. And I think we have a chance at breaking that record. So let's see.
It's not going anywhere anytime soon. But hello, everybody. It is Monday. So we're going to give you a little Macro Monday. That is John Walkup right over there. I am Noah Rosenblatt. We are both with UrbanDigs. And we're going to talk about some good stuff, guys. We're going to talk about where rates are, where the Fed is. We'll take a look at credit spreads. There's some crazy stuff going on in the markets right now, John. I don't know, the crypto markets and all that kind of stuff. Gold and silver is plummeting since the short call last week that we can't trade. Remember the short call? We can't trade. Yeah. We're going to go over some stuff, guys. Take a look at some macro stuff. Hopefully you guys will have some questions, comments, criticisms, whatever. We're going to try to talk about Manhattan. The new charts are in. It's February. New charts are in. I can't believe it's February already. I mean, the season's basically starting. It's right around the corner. So let's get right to it, guys. Let's get right to it. I want to look at the market ticker, guys. I want to look at 30-day activity in terms of supply and contract signed. Let you guys know where we're supposed to be. 1165 for supply. We actually came in light in January. I'll show you that in a second. Okay. But we're at 1165 for the last 30 days. That is supposed to be at 1361 for February, John. 1361 is your new benchmark.
This is what we've seen for the last, I don't know, however so long as supply coming in light, and continues to do so. Let's think we might see that change. I think we might see that change. I don't want to get too far ahead of myself, but I feel like we might start seeing a little bit of a flip this year, but we'll see.
We'll see. I mean, here's your monthly new supply chart. Okay, it's in the chart room on UrbanDigs. It's showing you the rolling seasonal average. So you could see what we're supposed to get for each month of the calendar year. There's February. That's how I got that 1361. And when I overlay the actual production chart right over there, you could see how we came in light. You okay over there, Johnny? You look like you got some stuff going on.
I always have stuff going on. Yes, I had to plug in my. If you must know, I had to plug
knobs and dials. I don't know what's going on.
I looked at my phone, and my phone's like at 3%. I'm like, oh, I didn't charge last night. I was like, so let me just plug it in on the side here while I'm
real world problems here, Johnny. Anyway, I'm trying to tell the people. That's right. I'm trying to tell the people that we're this is like the fourth month since September. September was the last time, and we had a pop in September. Yeah. This is the fourth month that we've been under trend. So supply is a little tight. Okay, guys, supply is a little tight. Let's go back to the dashboard. Let's look at contract signed 676. That is yet to really start turning the corner. I see it bouncing up off of its low right down there. I could see it, but that is supposed to be at 951 for the month of February. It feels like it's a long ways away. 951.
It does, but February is like, it's kind of like October in that sense. Like it starts slow, but then it sort of finishes strong. So, I mean, look, this is February 2nd. Right? So we have still a few weeks to go. February, of course, February, as everybody knows, or as most people know, is a shorter month, right? So I don't think it's a leap year. I think we're still on a 28-day schedule this year. Contracts. So less days per contract. So that being said, but look, this is the beginning of the season. You start to see a little bit of ramp up activity toward the end of February, but it's really March you want to really pay attention to. That's sort of the main bellwether. But I still think we're going to have a good February. I think we have a lot of contracts that could have been signed in January because of the snow, because of the cold. They weren't signed. I'm blaming that.
Here's your average of contract activity for the year, guys. This is your wave, right? This is going to be your spring wave right here. That's how I get my 951. If I overlay contract activity, let's just go back just to tell you guys where we're at. That's the whole goal of this show, is a little intelligent show. We had a good October. We had a decent September. You notice how the blue line's above the orange line? That's telling us we had a good month. Anytime you're above the orange, good kind of a thing, right? I can go back 5 years here and you can see how 2021 was and all that kind of stuff. So, yeah, above the orange, good. October, good. November, weak. December, we had a little pop towards the end of December. That lasted a couple of weeks, helped us push out. But again, a little underperformance. We dipped back down in January. I'm hearing a lot of things anecdotally about how active this market is, but it's not yet hitting the tape right over here. So
no, and it's that's interesting because I'm hearing the same thing. I mean, you and I obviously hear stuff, but I'm starting.
That's true.
There we go. I talk to a lot of folks, and I talk to people. I talk to agents with listings all across the spectrum. And this is one of the first times I recall that I'm starting to hear about traction in like the sub 2 million, and just on a recurring level. So it sounds like that market is slowly coming back to life. Not that it was dead, but it was, just sort of
right
starting to thaw a little bit. So that's I'm gonna keep touching.
Okay. We're going to keep an eyes on it, but I expect this to start to come around in the next days, if not weeks. Okay. You guys could check all these charts out in the chart room at your own leisure. I would like to pivot to the macro portion of the program, unless you guys have any questions or comments on current market conditions. Let's just pivot. We'll get back to Manhattan real estate towards the end. Let's go to the macro portion of the program, guys. Credit spreads. Just look at this line. We're not going to spend more than 30 seconds on credit spreads. We are still at stage 1.6. It's just not going anywhere. The markets are just kind of lingering out there. A lot of crazy volatility in crypto, in metals. Just we watch and observe. We watch and observe, right? We could talk about shorting silver like we did last week, but we're not going to do it. Okay?
Good talk.
Not going to do it.
You can talk a good game.
Guys, we are.
Yeah, so just zoom into the 1 month on the credit spread, because I think you just brought up an interesting point, which is a little bit of a little work up there. But you're right. We saw it in an incredible amount of volatility in both precious metals, cryptos, and some other things where they just whipsawed up, came right back down. Same thing in Bitcoin, cratering past 80,000 one day, going down to like almost 76, coming right back up. So it's like you have a lot of movement, but you look at credit spreads, they're like, okay, we're just kind of doing our own thing. So it's like, you zoom out a little bit, and that fear, if you use credit spreads as a fear indicator, it's not a lot of fear. It's just sort of more like internal realignment than it is sort of structural, oh my gosh.
Right. The activity that's going on in the markets has not yet funneled into any type of worries in the credit markets, right? And the credit markets are not a leading indicator. That's not what we're using it for. We're using it for a confirmation signal, a market signal of whether or not the credit markets are actually starting to worry about what's going on out there. And so far, I haven't seen it.
Yeah.
So
good point.
Nothing to see there. Okay. Questions? I see a comment.
Yeah. Someone, Abe Cops Up says, it seems like the ticker is showing us as thought it was a seller's market. So I'm not quite sure.
I know what you're talking about. So when you go over here, okay, look, when you go over here and you see this, it's just because we don't have a lot of space right here, and we wanted to put that this is the seller's market zone. If I go to the chart room, and we've talked about this internally, but it's a design thing. If I go to the chart room and look at the pulse, you'll notice that we're above the neutral line on this, but we're not in the seller's market territory at all. Don't use this little widget. Go to the chart room over here. Go to the chart room over here and use the market pulse, and you'll see we're above the neutral line. If anything, it's a supply-driven move higher in the pulse. Okay, a supply-driven move higher. It is not a demand move higher. We've discussed that over the last couple of Fridays. I'll write a piece about that and put it on the site in a little while. Okay. Back to credit spreads. My charts aren't loading. That's why I moved on from there. But here, this is where you would go. Market pulse. Right over there. That's where you would go. Okay. Nothing in credit spreads, guys. I don't see anything. Warning signal here. I want to pivot to rates. Guys. For rates, we're looking at the Fed fund futures. This is basically the bond market, basically. Right? Would you agree with that, John? Bond market? Okay. Yeah, basically the bond market. Yeah. You guys could do this yourself. It's the CME Fed Watch tool. Okay. What you need to know is this is where we currently are. This is the Fed funds rate. Okay, the Federal Reserve sets that benchmark rate based on the economy, based on inflation. That's where it is. And then a lot of lending is based off of that. rate. Okay. The market does not expect any move in March. You can see we're in the same category. No move in April, same category. First cut June, but that's only 48%. So we still got these 2 cuts in June and October. If anyone asks you any questions about what's going on with interest rates, buyers, sellers, what do you expect? The answer you're going to tell them is, well, when I look at the Fed fund futures market, okay, they're pricing in 2 cuts, one in June, one in October, but these are low percentage cuts or expectations. So we don't know what they're going to do. Just use caution. Okay.
Yeah, and I think the key here is you think about last week, the Fed, there was an announcement about the next chairman of the Fed is going to be Kevin Warsh, who's widely viewed as more of a hawkish member. The idea there is it's less about what the Fed is done and more about how they're going to approach things. And I think the concern is that you might see some hawkish movement from the Fed in terms of fighting inflation, coming out of this. But again, the faster they fight inflation, the faster rates can get back lower. So it needs to be seen. But right now, to your point, Noah, the rates look like they're on hold until at least June.
Yes.
Sort of future inflation or employment shocks in.
Yeah, right. I mean, every day there's new data coming in, and we don't know. We don't know what's going to happen a week, a month, a quarter from now, guys. So you got to just be careful about giving advice out there. We read the tape, guys. We read the tape when we talk to our clients. We don't want to insult anyone's intelligence. You're talking to Wall Street people out there. All right, let them know you know your business, but you're not getting out of your lane. You know what I'm saying? That's why we say it the way we say it over here, and that's what our job every week is, to keep eyes on. This is what John was talking about. Let's look at the headline: Bloomberg Economics NLP Fed sentiment model tilts hawkish to start 2026. I think that has a lot to do with that. You said, John, the new president's nomination for the Fed pick. He tends to lean hawkish, so I think this is now resetting. And you think about inflation. I have one inflation chart to show you today. I'm not going to go overboard on the macro economy, but I look at this chart. I don't know what you see, John, but we came down a lot. This is PPI, by the way, Producers Price Index is one element of inflation. It looks like it's just trickling higher to me. I don't know if I'm reading this wrong, but it looks like it's just not going down to that Fed target. So yeah, there could be a little more hawkish, which means you may not get those cuts that are priced into the market right now. And that could mean slightly higher mortgage rates in the future. We don't know.
It could, unless you think about 20 years ago, the Fed would set a target rate, right? And then they sort of move that rate to the discount window, and it's sort of the rate fluctuates within 25 basis points or a quarter of a point. Kind of that's the fluctuation. What if we started to see the same thing for inflation? So it's not like a target rate, but it's like a target range. Like I can imagine a target range moving from say 2 to 3%, just to sort of give us a little bit of a cushion here, because come on. We've done our best. We got it close, but it's not quite there. But yeah, you're exactly right. You're seeing we are above the Fed's target rate, which is just, if you're thinking one way or the other, if employment is holding steady or doing okay, you have to hike rates on that. I mean, that's the current thinking. But we're actually still seeing rate cuts. So let's see how this whole thing pencils in, because it's still a battle with the Fed.
That's a really interesting point you made about how the Fed might change its thinking rather than have that 2% anchor that's always there and it's always a level. Maybe they change that thought mentality a little bit, and it's more of a range, and it has a less impact on policy. So that's a real interesting thing. But this is what we see, guys. I continue to see a little battle between inflation and the jobs market. And that's kind of what I think you need to know. You don't need to go too crazy into this. The Fed's just stuck in the middle, right? Clowns to the left of me, jokers to the right. Stuck in the middle with you.
Nice. Steelers wheel reference.
I know. I feel like that scene in Reservoir Dogs. I don't know. Anyone know what I'm talking about?
I know exactly what you're talking about.
We gotta make it fun. We gotta make this fun. We need some drama and characters on this show. I don't know. Anyway, maybe not. Let's go to mortgage rates, guys. Let's go to mortgage rates. Nothing's going on here. Even with this slightly kind of stubborn inflation print over here, there's still 2 cuts being priced in, and as a result, mortgage rates are just not moving. Right? They're just not moving. So that light blue line, that's the jumbo rate. We're at 6.24. Mm-hmm. I mean, this is a 2-year chart. We're kind of at the low levels. So nothing to complain about.
No, it's not bad, and especially if you're looking at, say, like what the 10-year has done. I mean, the 10-year got down to like 4.1, I think it was, in late January. It's now at like almost 4.3. So the 10-year has really kind of come back. And you think about how mortgages are priced, the 10-year is a big component of that. So the idea is that we're starting to see a tick up in rates, but it hasn't flowed through yet to the mortgages. So I don't know what that transmission mechanism. Obviously, there's something in there that's blocking that out, and it could be what we talked about earlier. Credit spreads are essentially going sideways. So there's more of an appetite for this sort of investment, which would sort of compress that spread, which still makes mortgages more affordable, even though the 10-year is higher. So I think we're starting to see that come into play. But again, there's only so much that can go down before they start springing back up if the 10-year continues its ramp higher.
Yeah, I like how you correlate credit spreads and how this is going down, meaning the compression between rates and the 10 years also going down. And as a result of this going down and things getting kind of more stable and okay, that's having an effect on mortgage rates kind of going down. Interesting.
Yeah, it just provides cover. It provides extra cover to take that risk of the mortgages. So,
right. Because may I ask you a question, John?
You may.
If this spikes up or moves higher, would you expect mortgage rates to rise, even though the Fed might cut rates? Yep.
That's a great question. So now you're talking about the risk premium. So what's that risk premium going in? So obviously, a big chunk of it is what rates are, and then you add the risk premium. So the question is, I don't know. I don't know the answer to that, but I would expect you'd probably see the 30-year jumbo spike much higher.
Ooh,
because those
mortgages
are the ones
are not
that
based
hold on
off
the books.
those.
No,
Right.
and I think the conforming ones might hold steady or even dip because they're expecting, obviously credit spread spike. We're talking about bad news scenario, so the Fed's going to cut into that bad news scenario. You might see rates 30-year fixed rates go down on that, but at the same time you'll see jumbo spikes. So you might see a bifurcation in the data.
Bifurcation. Well, we haven't seen it, so we're not going to talk about it too much. We'll talk about if that ever happens. But going back to inflation, I don't really follow this too much. This trueflation. There's like different measures of inflation. Like I think the government measures have a lot of surveys, especially the consumer price index. I think is a lot of phone calls. Hey, what do you think's going on? And they put market kind of thing. These guys look at distribution prices. They got like warehouses and distribution prices, and every month they get a check, or every week they get a check on the prices. And we recently had a lapse of reporting from the BLS. That's what this right side is. So you got the Fed at inflation. Look at that BLS. It's not the Fed. I guess the government. That red line at the top is where they look at CPI inflation. This trueflation is looking at this way down. Now, just look at where it's down, but look to the left, 0.5. That means there's still rising prices. You got to go negative on this thing to see prices start to go down. So the fact that it's going down like that doesn't mean your prices are coming down. It means they're rising at a less fast clip. That's all that means. It's kind of confusing.
Yeah, but what's interesting about this chart is, this is a year look, and it's just really plummeting into December, into the early part of this year, which is almost the exact opposite of what you've seen from the BLS standpoint, the Bureau of Labor Statistics, where they call it. So you start to see that line is much higher. So this is well below the Fed's target. So this to me is like, if you want to cut rates, this is like cut territory. Go for it. But
yeah.
I tell you, it's suspect, Noah.
It is suspect, but it makes you wonder what this is going to do. And like, does this follow, right? Does this follow the lines over here? And it's gonna be interesting what happens. Like, is that foretelling something? I don't know. But a lot of people look at this kind of stuff. So I thought it would be interesting because they're talking about it. They're talking about like which is right of these two measures. Housing, I got to make this a little bigger. I'm in the territory where my charts are different sizes. So I'm going to go chart to chart. It's going to have to go plus and minus. Everyone's asking me, guys, let's go outside our market a little bit. We all know that the national housing market has been in a funk. It's been in a funk for a while, but you're starting to see something like people ask, how do you know when it's going to start going up again? Well, one real-time measure is mortgages, right? Purchases, refinances. Both refinances are going up and mortgage purchases are going up. Now, I don't know if this is going to translate into another wave cycle. These go in waves. Usually we have a wave, right? And we've been in this down wave for years now. Same thing in Manhattan. You can argue we've been in for 10 years, but this is showing something. So let's just see if it comes through.
Well, I think you hit the nail on the head. This has been going on
Never heard you
for
say
years. I know. That's why I like to say it over and over again. right? So
Yeah.
it's a question of time, right? So that you could obviously get your way out of the situation, get yourself out of a slow market with an influx of demand, right? That'll, but let's say rates went back down to zero, everyone jumped back in, the markets get going again. Great, we did it. When that's not the case, when affordability is the issue and you have mortgages at a high rate, we're really talking about finance dependent homes here, right? This is what this chart is really looking at. If you talk about those, it's a time issue, right? Because you have people who aren't selling because they're locked in, and you have people who aren't buying because they can't afford it. But at a certain point, right, time is going to clear all of that, because it's like, oh, I got another kid on the way. Oh, there's a divorce. Oh, there's some life thing that's just at some point is going to happen. They're either going to become a seller or a buyer. So you have, I think on both sides, you have pent up levels of demand. I think you have pent up levels of supply. And at some point, time is going to sort of force those. And if you can get mortgage rates down below 6%, which I think they're fighting to do, if you can get that, I think you start to see a little bit of release on both of those.
Right.
And that's a little bit of gasoline into this market, which would be nice to see. A little bit of sputter in that engine again.
A little bit of sputter in that engine. Let me go back to this chart. See how I'm saying? I got to go this. Dale says, very echo John on this chart. This looks suspect, and I agree with you as well. But again, guys, when we look at this, very important to note that zero. This still means prices are rising. What they're saying is prices are still rising. They're not going down. They're still rising, just at a slower clip. That often gets miscommunicated. All right, I agree. Could be suspect. Let's move on. We're getting towards the end of the program here, guys. I found this little guy from Realtor.com. Top U.S. buyers markets. Hey, guess who's on the list? Look at us. Woohoo! Number 5. But that's New York, New York. That's New York, New York. So this is looking at, I believe, months of inventory, right? I guess a level of absorption. The higher you go up, more of a seller's market. You go down, kind of a buyer's market. 7.1 they have for New York, New York. I guess, what is that? Is that all of New York City? Queens, Brooklyn, et cetera, et cetera.
I don't know. When it comes to like stats by like Realtor.com, like, no disrespect to Realtor, but when you're saying New York, New York, I don't know what you're talking about, because you want to talk about Manhattan? Okay, I'll talk about Manhattan. You want to talk about Brooklyn? Because
this is Manhattan.
You're seeing different things in different boroughs, which is why you look at something like that and people are like, oh, New York is doing this. Like, no, not really.
Yeah, and I got, in case you guys are wondering, we have months of inventory chart in the chart room. This is what months of inventory for Manhattan is. We're at about 6 point. I like to look at the most complete month, 6.2. The leading indicator months are still kind of glass half full type of thing. More data to come in, subject to change. Those are lower, probably because supply has just been tighter, right? So the months of inventory is naturally going lower. But this is kind of stable. The only movement we really had was our post-pandemic, pre-pandemic, in pandemic, post-pandemic kind of reactions. So I don't see anything here.
I don't either.
But we are a buyer's market.
Well, it depends. It depends on what you're looking for. I think that there's certain markets in which you have certain seller markets. I don't think we're at the stage with enough participation that you can say it's one market either way. I think, and I'm going to go back to my lily pad market argument, I think people who are in this market are in there for a reason. So you have sellers who want to sell, you have buyers who want to buy. And it's a question, when they meet, you have a market. But I don't think you have a lot of sellers who are just like, yeah, if I get my price, I'll take it. And I don't think you have a lot of buyers who are like, yeah, I'm just shopping around. If I see something for, maybe I'll just buy it because why not? Maybe I'll just keep it as a second home. I don't think you don't have those marginal buyers. You don't have those marginal sellers right now. So I don't think you can really point it either way, because you don't have the distressed. I don't think you have enough distressed sellers to say it's a buyer's market. And I don't think you have enough aspirational buyers to say it's a seller's market. So
good point.
Neutral.
Nikki, thank you so much for pointing out. If you look at the article accompanying it, the average note is something like under 800K. That makes sense. Sense. Stick with the UrbanDigs months of inventory. I think it's more telling, especially our listing climate. Yes.
Thank you to Nikki, as always, for reading the fine print.
Always look at the listing climate. Always look at the listing climate in Manhattan as well. It'll give you a lot more information. I mean, guys, honestly, if you want to figure out what our market is doing right here, you got the climate index right over here. You got the liquidity chart right over here. These two elements are going to tell you more information. Those are your top two. Outside of that, there's a distant 3, 4, 5, 6, 7. But I would keep an eye on that. Supply is
but even then, to the credit of the site UrbanDigs and the brokerage community, you got to still hyperlocate it, right?
Got to hyperlocate it. Even when you do that, you're going to have buildings in the hyper-located zone that are over and underperforming. I mean, you're going to have pre-war co-ops right next to each other that are doing completely different things. As Fred Peters likes to talk about, is a building by building market. That's why it's real tricky. You need brokers. And the final chart I got, guys, is this reventure Reventure put out a home value to rent ratio. Again, this is the broader market. This is more macro. This is Macro Monday to kind of let you know, is it a bubble or why we're in a bubble? Blah, blah, blah. You can see where the other bubble was. I don't think we're in a housing bubble at all, but it's very, very clear that wherever we are now in the national housing market, we are years into the turnaround, the correction type of thing off of the peak level, which was probably 21, maybe 22, early 22, and now we're in 26. So I don't know where this goes, but you're not dealing with a bubble situation, especially not in Manhattan. So keep that in mind. Thought it was interesting.
Right. Well, I mean, I guess it depends on how you define bubble. And I usually think of I think there's a lot of structural reforms made at the mortgage level that sort of got rid of a lot of the excess
Ninja loans.
purchases. Yeah, the ninja loans, all that kind of stuff. Like, if you're not, I think you see a bubble when you have people buying 4, 5, 6 homes because it's free to do so and you get the income and are great. What could go wrong? And I don't think we're in that mode of thinking. So I think psychologically it's not a bubble. If you want to look at it from the price level, which I think they're trying to do, maybe you could make that argument, but I don't think that's what makes a bubble. So
what they're really saying here is that it's cheaper to rent is basically, and guys, I mean, listen, it's true. Like, I mean, even if you look at Manhattan and you're going to rent the 2-bedroom, you're going to buy a 2-bedroom, it is most likely going to be less expensive to rent that property. And until that starts to normalize a little bit, the sales market might go sideways / down. And that's kind of the dynamics that's going on right now. Even with the rising rental market and a sideways sales market still happening. It still has a correction to do. Yeah, interesting. And that's all I got, guys. That's all I got. We got some interesting stuff coming up. I got Eric Gislason over at Brown Harris Stevens coming to us tomorrow to talk about collaborative negotiation. We're just going to hand the torch to Eric tomorrow. He has a whole bunch of things to say. Those of you that know him, he is wicked smart, and it's going to be really interesting. Yeah, so hopefully you guys can join us. Outside of that, I don't have much to tell you guys. Good luck. Keep telling us anecdotal stories. We want to hear everything that you're going through to boots on the ground. And I don't know. See you tomorrow and see you next week.
Yeah. See you next week, everybody. Thank you for joining us. Always reach out to Noah at UrbanDigs or John at UrbanDigs if you got questions. Or if you want a trial, give us a call.
Good luck out there, everyone. Talk to you later. Bye-bye.
Bye.